Welcome back to Market Insight Cast, your go-to source for in-depth market analysis and strategic financial insights. We're here to cut through the noise and give you the clarity you need to navigate the complexities of the financial world.
Hello, and welcome to the Deep Dive. This is where we take a stack of your sources, articles, research papers, our own notes, and we meticulously extract the most important nuggets of knowledge, the key insights, really custom tailored for you. Today, we're embarking on a truly fascinating deep dive into one of the world's most, ubiquitous and valuable companies, Visa Inc. You know them, ticker symbol V. It's an absolute powerhouse in financial services, fundamentally built on making electronic fund transfers happen globally. Mostly through those Visa credit, debit, and prepaid cards you see everywhere, practically household names. Our mission today is pretty straightforward, but also ambitious. We want to equip you with a really comprehensive understanding of Visa's recent financial performance, its strategic position in this, frankly, rapidly evolving payment industry, and what the future might genuinely hold for this titan. We'll be looking at everything.
From their latest earnings reports, the big numbers, to the cutting-edge tech trends shaping how we pay. Think AI, digital currencies, all of it. Okay, let's unpack this. Now, I'm particularly intrigued, maybe even just excited about Visa's trajectory. I mean, you look at their consistent historical performance, the innovative strides they keep making. It's impressive. But as always, we're joined by an expert who brings that crucial analytical lens, helps us see all sides, ensures we don't miss those critical details or, the potential challenges that might not jump right out. Right, let's kick things off by setting the stage. We need a foundational snapshot of Visa's, truly massive market presence and some of their recent, undeniably impressive financial wins. Visa Inc., headquartered out in Foster City, California. It's way more than just a credit card company, right? It's a multinational financial services corporation. It acts like the connective tissue for literally trillions of transactions worldwide. At its core, Visa is a technology company. It operates this incredibly vast electronic payment network, enabling, seamless, secure fund transfers between consumers, merchants, banks globally through those universally recognized Visa cards. And it's a company that consistently ranks among the world's most valuable, as we'll explore their very compelling reasons for that. So, as of March 34, 2025, their key financial indicators are, frankly, staggering. Market cap sits at a colossal $697.478 billion. Just pause on that number. To put that in perspective, that valuation places them among an elite group of global corporations. It reflects immense investor confidence in their business model, their future prospects. And when you look at profitability, equally impressive, it signals incredible operational efficiency, a powerful ability to generate cash. Their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, was $26.225 billion. This metric, it's a fantastic proxy for a company's operational profitability, right? Strips out financing effects, accounting decisions, and Visa's number here shows a really robust underlying business. Their PE ratio, price to earnings, is 35.85. Now, that's a relatively high multiple. It means investors are willing to pay almost 36 times Visa's annual earnings per share. It suggests strong growth expectations, definitely. But it also implies maybe less room for error if those expectations aren't consistently met. Digging deeper into their financial health, their earnings per share, EPS, over the trailing 12 months TTM came in at 9.96 cents. That's a direct measure how much profit Visa generates for each share of its stock out there. Their total revenue, TTM, reached an impressive $37.621 billion. And get this, their gross profit was remarkably close behind at $36.782 billion. That nearly identical figure for revenue and gross profit, it's a clear testament to that asset-light model they run. They don't hold the credit risk. See, they just facilitate. So almost all that top-line revenue flows right into gross profit. It's a key reason for their exceptional profitability, their capital efficiency, and their operating margin at 0.671 or 67.1%. That just reinforces this operational prowess. An operating margin that high is incredibly rare for any company, let alone one of Visa's scale. It indicates strong pricing power, effective cost control, a dominant market position you rarely see elsewhere. Looking at returns. Return on assets TTM was 0.169, return on equity TTM a remarkable 0.507. These figures showcase how effectively they convert assets and shareholder equity into profits. Again, highlights efficiency. And for the recent quarter, healthy 9.3% year-over-year revenue growth, which for a company this size is anything but trivial. So it's no surprise analysts are quite bullish. Average target price, $384.34, underscoring that market confidence. Honestly, when you look at these numbers, what truly stands out is Visa isn't just big. It's incredibly profitable, astoundingly efficient. The sheer scale combined with that profitability, it's astounding. Reflects a truly dominant, resilient market position. And this isn't just about abstract big numbers either. It's about a company that consistently delivers robust financial performance, even amid dynamic global economic conditions. This kind of underlying financial health, it isn't just, a nice to have. It underpins every other strategic move, every growth opportunity we're going to discuss. It provides a solid bedrock for their future.
Well, those headline numbers and the operational efficiency you've laid out certainly paint an impressive picture, no denying that. But it's absolutely crucial for us to delve into some of the nuances, the undercurrents, particularly when we look at the distinction between GAAP and non-GAAP figures. Well, non-GAAP numbers, those adjusted ones excluding certain one-time items, yeah, they show robust performance. Net income up 6%, EPS up a very healthy 10% year over year, but it's equally important to acknowledge that their GAAP net income, strictly following generally accepted accounting principles, actually decreased by 2% year over year. Now, that seemingly contradictory movement needs a closer look, a more critical look, really, for any informed investor. This decrease in GAAP net income was largely, and quite significantly, driven by a substantial $992 million litigation charge, nearly $1 billion. This charge is directly tied to the interchange multi-district litigation, the MDL. Now, for you listening, interchange fees are basically the transaction fees merchants pay banks when you use your card. It's a massive fundamental revenue stream for networks like Visa. And this specific MDL alleges those fees are anti-competitive. So if we connect this to the bigger picture, while Visa's underlying business, captured by non-GAAP, seems strong, showing core operational health, this litigation charge highlights a recurring, often substantial risk in the payments industry. Regulatory and legal challenges. It's a stark reminder. Even dominant players aren't immune to these external pressures, and they can hit the bottom line hard. It shows that even with strong operations, unforeseen legal liabilities can significantly dent reported profitability. And think about it, that's nearly $1 billion not reinvested into AI or new markets. A real opportunity cost potentially slowing them down versus competitors. Furthermore, while those growth rates for payment volume and processed transactions are certainly positive, it's worth critically questioning how sustainable some of these drivers truly are. Long term, for instance, a huge chunk of Visa's revenue, and therefore its growth, hinges heavily on consumer spending. So this raises an important question. Is the current consumer spending trend as robust as the headlines suggest?
Or are we maybe seeing a peak after that post-pandemic rebound? We've seen periods not that long ago where consumer spending can shift quickly. They can pull back, reallocate based on macro factors, inflation, interest rates, jobs, even just confidence. Any such shift directly hits payment volumes, cross-border traffic, and ultimately Visa's top line. This inherent dependency on consumer behavior creates volatility. It's not a guaranteed straight lineup. Even slight shifts in the broader economy could temper these growth figures. So we need to ask, is the current pace really indicative of long-term steady growth? Or is there a cyclical element here that could bring significant headwinds later on, maybe impacting their ability to hit those high investor expectations?
That's a really important context on the GAAP versus non-GAAP and the consumer spending reliance. Building on that, let's dive deeper into the specifics of Visa's Q2 2025 performance. This is where we really unpack the operational engines driving the company, demonstrating that underlying strength. First up, payments volume. Increased a solid 8% year-over-year constant currency basis. For you, the listener, this is a clear, direct indicator. Consistent consumer adoption, healthy spending habits across Visa's huge network. It means more people actively using Visa cards for everyday stuff, which, as we said, is the bedrock of their whole model. Sustained growth signals confidence. Now, here is an area that always gets attention, shows real strategic value. Cross-border volume. This metric saw a significant 13% increase, excluding intra-Europe. Total cross-border also up an impressive 13% constant currency. Why is this so compelling? Well, cross-border transactions are often higher margin for Visa. They usually involve extra fees, currency conversion, international processing. So this robust growth reflects not just strong global economic activity, but also that continued vigorous rebound in international travel. People are crossing borders, businesses are trading globally, and Visa's right there, facilitating these higher value transactions seamlessly. It's a direct indicator of a recovering, interconnected global economy with Visa as a prime beneficiary. The sheer scale of their operations is also just strikingly evident in their processed transactions. Hit an astounding 60.7 billion transactions.
Billion with a B. It's hard to even conceptualize.
Exactly. Represents a 9% increase year over year. Think about that. 60.7 billion individual transactions flowing through their network in one quarter. It's a powerful testament to their incredibly robust tech backbone, their widespread, near-universal acceptance globally. This immense volume speaks volumes about the reliability, the efficiency, the sheer capacity of their infrastructure. That's a critical competitive advantage, handling massive scale with precision and speed. Another incredibly positive, forward-looking sign, growth in Visa Direct transactions. Soared an impressive 28% year over year. Now, for those maybe less familiar, Visa Direct is their real-time push payments platform. Enables instant money transfers directly to eligible cards or accounts globally. Think Venmo or PayPal, but built right into the Visa network. Send money instantly to almost any Visa cardholder or even bank accounts globally, bypassing those slower traditional bank transfers.
Which is a huge market they're tapping into.
Absolutely. This is a fantastic sign of growth in what Visa called new flows areas beyond traditional point of sale. It shows they're successfully capturing a growing slice of the peer-to-peer, P2P, business-to-consumer, B2C, even business-to-business, B2B, real-time payment market. Huge area of innovation, increasing demand, positions them to capture value from a broader range of payment types, and their growth doesn't stop with just processing transactions. Their value-added services VAS revenue grew an impressive 22% constant currency. This metric is incredibly important. It tells us Visa is successfully diversifying revenue beyond core transaction processing. These services, high-value solutions, advanced fraud prevention tools, sophisticated data analytics for merchants, tailored consulting for banks, robust identity verification platforms.
Creating stickier relationships.
Precisely. This diversification shows Visa isn't just a payment rail, it's becoming a comprehensive solutions provider, creating those sticky, long-term client relationships, finding new, higher-margin ways to monetize their vast network and invaluable data insights, enhances resilience, growth potential significantly. Beyond the raw numbers, they're making significant strategic moves too. Continued substantial increase in tokenized transactions, 13.7 billion total tokens. To put that in perspective, roughly 50% of global e-commerce transactions on their network are now tokenized. Tokenization, it's critical security. Sensitive card data gets replaced with unique, encrypted digital tokens, useless if intercepted. Enhances security, convenience, makes transactions safer, smoother for everyone. It's proactive protection of user data, fraud prevention, building trust. Network expansion is also remarkable. Commitment to global reach. Added over 1 million new merchant locations. Key growth markets, India, Mexico, Brazil. Expands their physical and digital reach into burgeoning economies. Solidifies their global footprint. Ensures Visa is accepted wherever commerce happens, physical store, online marketplace, deepening penetration in high-growth regions for future volume. Finally, a clear, strong signal of confidence from management in future earnings, commitment to shareholder value. The board approved a new $30 billion multi-year share repurchase program.
$30 billion is a significant statement.
It is. Signals the market they believe their stock is undervalued. Buying back shares boosts shareholder value, reduces outstanding shares, increases EPS. Ryan McInerney, Visa's CEO, summarized the quarter perfectly. Cited healthy trends in payments, cross-border, processed transactions driving net revenue growth, even amidst macroeconomic uncertainty. This paints a very optimistic picture for Visa's operational strength, future prospects, truly leveraging every part of their immense network.
Okay, while those growth numbers are certainly eye-catching, and the strategic moves show they're not standing still, it's crucial we identify those undercurrents, potential headwinds, rising costs, things that could temper this rosy picture and warrant caution for sophisticated investors. If you look closely, the report acknowledges a potential softening in specific high-value travel categories, like airfare and lodging. While overall spending is called robust, this raises an important question. Are these early signs of broader consumer spending fatigue, or just normalization after that intense post-pandemic surge? Any significant slowdown in discretionary spending, especially high-margin areas like international travel, directly hits those lucrative cross-border volumes Visa counts on for outsized growth. It's not just a minor dip. Could it be a, canary in the coal mine for larger shifts driven by economic pressures? Furthermore, currency weakness in certain regions was noted as impacting cross-border volume growth. Now, if we connect this to the bigger picture, persistent global currency volatility driven by geopolitics, differing monetary policies, myriad factors could significantly dampen what's currently a very strong growth driver. For example, a strong U.S. dollar makes international buys less appealing for foreign consumers, reduces the dollar value of those transactions when Visa converts back. It's external, mostly beyond their control, but directly impacts a key revenue stream, adds unpredictability to cross-border performance, the mention of geopolitical risks, challenges in regulated markets. It's not new for Visa, operating globally, but it's a constant, evolving threat demanding serious attention. Governments worldwide are increasingly scrutinizing interchange fees, that major revenue source we discussed. They're also looking at the overall market power of large payment networks. This heightened scrutiny could lead to adverse outcomes. Mandated revenue caps on fees, increased compliance costs in various places, even legislative pushes for lower transaction fees. All would directly erode profitability. We've seen it play out, like in the EU. It's a persistent, potentially escalating risk. Could constrain revenue growth, even if volumes increase. A continuous regulatory tightrope walk. Then there's the issue of rising operating costs and client incentives, a tangible headwind to profitability. While non-GAAP operating expenses grew, you said, a modest 7%. It's critical to note GAAP operating expenses all costs jumped a substantial 22% year over year.
That's a big gap.
A very big gap. Highlights real cost pressures beyond the adjusted figures. What's driving it? Higher labor costs, common theme, inflation, talent competition, increased marketing spend to keep market share, rising professional services fees, legal, consulting, higher network processing costs, fundamental expenses to run that immense global business. Moreover, higher customer incentives are anticipated in the second half of the fiscal year. These incentives are essentially revenue reducers. Visa pays out more to clients' banks, issuing cards to encourage issuance, drive volume. This directly impacts the net revenue Visa keeps. These incentives are deducted from gross revenues. The fact they're projected to exceed $4 billion, that's substantial, cannot be overlooked. So while top-line revenue might look strong, they might be spending significantly more to maintain share, drive that volume. Directly eats into the actual profit margin. Suggests achieving growth might come at higher cost than you'd think. Finally, the looming specter of broader economic uncertainty, tariffs, explicitly acknowledged as a potential future impact. Critical external factor. It's not just about what Visa controls internally or direct competition. It's the broader global economic environment. A significant global slowdown, trade war escalation, unforeseen crises could quickly dampen consumer and business spending alike. Directly impacts payment volumes, all categories, regardless of Visa's internal strengths. So if we connect this to the bigger picture, these factors, while maybe not dominant this quarter, represent real persistent challenges, add risks to future forecasts. They suggest that even with strong headlines, there are underlying cost pressures, significant external risks that could eat into profitability, slow growth. Demands constant vigilance from investors. It's about looking beyond the surface, understanding the full ecosystem Visa operates in.
That's a crucial perspective on the internal and external pressures. Absolutely. But now let's shift focus to the battleground itself, Visa's formidable position in the competitive arena, which is undeniably one of its greatest strengths. Visa, alongside MasterCard, American Express, they truly dominate the global credit card transaction landscape, together accounting for the vast majority of transactions in 2024. This isn't just market share, it's about a deeply ingrained network effect, established user behavior, makes them incredibly hard to dislodge. Visa operates on that asset-light payment network model we mentioned. What does that mean for you? Essentially, they separate card issuance from network ops. Unlike some competitors, Visa doesn't directly issue cards or lend money. Instead, they provide the crucial tech, the infrastructure enabling banks worldwide to issue Visa cards, process transactions globally. Very similar model to MasterCard's, incredibly capital efficient, lets them scale globally without taking on credit risk, minimizes financial exposure, maximizes operational leverage. One of Visa's most significant enduring advantages, unparalleled acceptance rates. Near universal 99% acceptance in the U.S. Use your Visa almost anywhere. Major retailers, small businesses, online, offline, and globally, reaches over 200 countries and territories. This massive footprint is fundamental, makes it arguably the most widely accepted payment method worldwide.
That acceptance is definitely key to the network effect.
Absolutely. When merchants sign up for payment processing, Visa acceptance is almost always a given. Drives immense, continuous volume through their network. Powerful, self-reinforcing cycle. Let's put this dominance into perspective. Some compelling 2022 data. Cards in circulation, purchase volume. U.S. alone, Visa had an astounding 385 million cards circulating. Compare that. MasterCard 309 million, Amex 62 million. That sheer number of active cards directly translates into volume. U.S. credit card purchase volume. Visa held a commanding 52% market share. Processed a staggering $2.84 trillion, significantly outpacing MasterCard 24%, $1.52T, and Amex 20%, $1.08. Overall 2023 card transaction volume, Visa processed an incredible 266.51 trillion transactions, dwarfing MasterCard's 170.83 trillion. Amex is 11.44 trillion. These numbers aren't just stats, they paint a clear picture. Unrivaled scale, unparalleled reach, established market leadership, truly dominant. Ultimately, Visa's key strengths lie in that unparalleled ecosystem built on vast global reach and robust AI-powered fraud prevention. Their scale is so immense makes them incredibly difficult to displace. Classic network effect. More users attract more merchants. More merchants attract more users. Creates a powerful virtuous cycle, deeply entrenches their market position, creates significant barriers to entry for competitors, and crucially, they're not resting on their laurels. Visa has a very clear, proactive innovation strategy designed to maintain, expand their lead. Introduced concepts like flexible credential, allows users unprecedented ability to toggle between multiple funding sources. Single card, imagine. Debit, credit, maybe loyalty points, all accessible through one card. More convenience, choice at point of sale.
Interesting concept, merging functionalities.
Right. Their AI commerce platform, poised to revolutionize shopping, payment experiences, using AI to make transactions smarter, personalized, seamless, and for the often overlooked business world, B2B Connect. Specialized solutions streamlining complex, cross-border B2B payments, an area historically rife with inefficiency, ripe for improvements in speed, cost. They're actively investing, developing these new solutions, ensuring they maintain and expand their lead in the rapidly evolving payments landscape, addressing both consumer and business needs.
You've certainly made a strong case for Visa's dominance and their strategic innovations. No question. However, it's essential to nuance this competitive landscape. Critically examine the specific market dynamics that could pose significant challenges, even for a company like Visa. Let's look at MasterCard. Yes, they share the asset-light model, close competitor, but MasterCard's shown consistent strong revenue growth, impressive operational leverage, coupled with aggressive fintech partnerships, substantial AI investment, suggests a formidable, arguably more nimble competitor in certain areas. This raises an important question. Is Visa's sheer size always an advantage? Or could it potentially lead to slower adaptation, less agility compared to a slightly more nimble competitor like MasterCard? Especially in fast-moving segments like embedded finance or real-time payments. Larger organizations sometimes have more inertia when fundamental shifts happen. Then there's American Express, fundamentally different model. Issuer and network. They issue cards, manage their own network, allows them to target a premium customer base, boasting consistently high customer satisfaction, loyalty, offering tailored benefits, services. Amex has also shown particular success attracting millennials and Gen Z, crucial demographic for future growth, given their increasing purchasing power, distinct payment preferences. So this raises a question for Visa. Can they maintain aggressive growth, capture higher value segments if premium customers increasingly gravitate towards specialized high service experiences like Amex offers? And how will Visa adapt to Amex's success engaging younger generations? They might prioritize different aspects, maybe bypass traditional cards altogether. It's not just raw volume, it's capturing valuable, loyal segments. Now, connecting this to the broader picture, a critical point is that all three major players, Visa, MasterCard, Amex, face increasing regulatory scrutiny over interchange fees.
A shared headache.
Exactly. Not just a risk for one, it's an industry-wide headwind. Could cap potential revenue growth for all of them, regardless of individual advantages. Governments, consumer groups worldwide constantly push for lower fees, argue they burden merchants, consumers. Such regulatory pressure directly impacts profitability of every single transaction, a pervasive threat. Could force fundamental adjustments, reduce overall margins across the industry, harder to generate the same profit from increasing volume. Finally, let's consider the broader pace of innovation, potential for disruption in payments itself. While Visa is innovating AI, B2B Connect, flexible credential, the industry sees massive disruption from multiple angles. Emergence of alternative payment methods like direct account-to-account, rise of nimble fintechs offering specialized solutions, rapid global expansion of real-time payment schemes that might bypass traditional card networks for certain transactions.
So, competition beyond just other card brands.
Precisely. Competing with entirely new paradigms for moving money. Think popular P2P apps facilitating instant transfers without a card network. Or the potential future of central bank digital currencies, CBDCs, could entirely reshape the foundational layers. These emerging methods could siphon off significant volume or fundamentally reduce the necessity of a traditional card network for certain payments. The critical question: can Visa's innovation truly outpace or fully absorb these fundamentally disruptive forces? Or do they represent long-term erosion of their core model, potentially reducing them to a back-end utility rather than the primary payment interface? It's how they adapt to a world where their network might not always be the default or preferred choice for every transaction.
That's a crucial point about disruption, and it leads us perfectly into this next section, because here's where it gets truly captivating. The payment industry is an undeniable hotbed of innovation, a sector undergoing constant, rapid transformation. And Visa isn't just participating, they're actively shaping the future of how we transact. They're strategically positioning themselves to lead the charge in several truly groundbreaking areas. First, AI-powered payments and security. Massive focus for Visa. AI and machine learning are pivotal for robust, proactive fraud detection, protecting consumers, merchants from evolving threats. But it goes way beyond that. AI enhances customer support, intelligent chatbots resolving complex queries instantly, automating sophisticated financial reporting, analytics providing unparalleled insights. Visa's shown serious commitment here, investing over $10 billion in AI-based solutions, fraud prevention, data protection past 5 years alone.
That's a significant investment.
It is. Proactive, large-scale investment signals dedication to future-proofing security, significantly enhancing user experience. Their new AI commerce platform, for instance, poised to revolutionize shopping and payments, making transactions smarter, safer, more seamless for everyone, leveraging vast data to predict, prevent, personalize. Next, rapid global expansion of real-time payments, RTP. These systems are gaining traction worldwide, fundamentally changing expectations around transaction speed. Forecasts: astounding 575 billion RTP transactions by 2028, making up a significant 27% of all global electronic payments. Massive leap from today. Initiatives like US FedNow are accelerating adoption of instant low-cost settlements. Profound shift from traditional batch processing that took days. Visa is incredibly well positioned to integrate, capitalize on this shift, facilitating faster transactions for consumers, businesses. They can build on top of these new rails, leverage their network for security, value-added services, or integrate directly, ensuring they capture value from this accelerating global trend towards immediacy. Then there's the rapidly evolving frontier, blockchain and digital assets. Blockchain tech, cryptocurrencies, stablecoins, tokenized assets, profound potential to transform global finance, especially B2B, commercial payments. Promise enhanced speed, security, efficiency, reducing intermediaries, lowering transaction costs. Particularly for cross-border, Visa's not sitting on the sidelines. Actively investing in stablecoin payment settlement solutions, robust tokenization tech, exploring how to bridge traditional finance with a decentralized future.
Trying to stay relevant in that space.
Exactly. Shows remarkable foresight. Ensuring they remain relevant, capable of participating in, benefiting from the evolving digital asset landscape, proactively exploring how to leverage these innovations, not be disrupted by them. A key, rapidly expanding growth area, increasing importance of value-added services, VAS payment companies increasingly diversifying revenue beyond simple transaction processing. Offering sophisticated consulting to banks, providing targeted marketing insights to merchants from their vast transaction data. Advanced fraud prevention tools as a service, robust identity verification solutions. Visa already offers an impressive portfolio, over 250 different VAS. Critical growth area, demonstrates ability to provide comprehensive, sticky solutions to clients, banks, merchants. Going far beyond just moving money, creates deeper integrated relationships, generates recurring high-margin revenue streams, less susceptible to pressures on interchange fees, and of course, can't forget emerging payment methods changing consumer habits. Digital wallets, Apple Pay, Google Pay, rapidly expanding buy now, pay later, BNPL. Even biometric payments, fingerprint, facial recognition for transactions. Gaining widespread adoption across industries, consumer segments. Visa's actively adapting, ensuring their vast network supports integrate seamlessly with these diverse options, ensures they remain at the forefront of how people choose to pay. Tapping a phone, spreading payments using physical identity, making sure they're enabling new habits not left behind. When we combine all these forward-looking elements, Visa's core future strategy becomes incredibly clear, built on several key growth pillars. Accelerate revenue growth in core consumer payments, making transactions easier, more secure. Expand significantly into new payment flows, B2B, P2P, largely untapped markets for traditional card networks. And importantly, deepen penetration in those high-margin value-added services. Beyond growth, committed to strengthening their core business foundation. Strategically, enhancing core banking, card issuance processing capabilities through key acquisitions like Pismo.
That was a significant acquisition.
It was. Broadens reach into crucial back-end financial infrastructure. Offer more complete suites to bank clients. Actively enhancing cross-border B2B payments. Solutions like B2B Connect reducing friction, costs. Even piloting stablecoin settlements for efficiency, speed, and international transfers. Providing flexible payment solutions like Flexible Credential. Giving consumers more choice, toggling funding sources from one card. Ultimately, overarching goal: maintain market dominance through their vast network, unparalleled data processing capabilities. All indicates Visa's strategy is clear. Innovate, expand, diversify, not just reacting, actively investing to lead. Proactive approach ensures sustained relevance, robust growth long-term, positioning them firmly as a leader in the evolving global payment ecosystem.
Well, while Visa's significant investments in these emerging trends are certainly notable, it's crucial we critically examine the pace, the potential for fundamental disruption, as well as the inherent risks these very trends introduce to Visa's long-term model. Take AI adoption. That $10 billion investment over 5 years is substantial, yes. But it raises an important question. Is their AI strategy truly disruptive, creating entirely new revenue streams? Or is it primarily focused on incremental improvements to existing systems, optimizing fraud detection, enhancing customer service? Startups, tech giants might be innovating far faster in specific, specialized AI applications, could eventually challenge traditional payment models, maybe enabling completely new transaction types, radically reducing processing costs in ways Visa hasn't fully embraced. Is it revolution or optimizing the status quo? The rise of real-time payments, RTP, like FedNow, undeniable force, but also a double-edged sword for Visa. Sure, Visa can integrate benefit from increased overall volume of real-time transactions, but these systems inherently could bypass traditional card networks for certain payments.
Instant bank-to-bank transfers might reduce need for a card intermediary, directly reducing Visa's interchange fee revenue on those specific flows.
So, gain in one area, potential loss in another.
Potentially. While Visa can participate, the critical question for future profitability is, how much new revenue will they capture from these new flows versus what they might lose from existing ones migrating to cheaper, faster, direct rails? Complex balancing act, ultimate net impact on bottom line. Uncertain. Now, connecting this to the bigger picture, exploration of blockchain and, more significantly, central bank digital currencies, CBDCs, by over 90% of central banks worldwide, could fundamentally reshape the entire payment landscape, directly threatening traditional networks. If governments issue their own digital currencies, establish direct settlement rails, effectively acting as issuer and processor, it could significantly diminish the role of private networks like Visa. Why need an intermediary if the central bank provides the digital currency and the direct means of transfer, person to person, business to business?
That's a fundamental shift.
It is. Not just a new payment method, a new foundational layer for money movement. That projected 260,000% transaction growth for CBDCs by 2030 aggressive forecast? Yes, but signals a massive potential shift. Could directly disrupt Visa's core model, potentially reducing revenue from processing fees cross-border as transactions move onto these new government-controlled rails. Questions the very necessity of their intermediary role for a significant chunk of future global payments. The growth of embedded finance, proliferation of BNPL, rapid expansion of neobanks also indicates significant decentralization of financial services. Payments increasingly integrated directly into non-financial apps experiences, often making the underlying payment rail invisible to the consumer. Example, buy on e-commerce, pay via BNPL option. You're not always thinking about the card network beneath. This raises a question. Will Visa primarily become a back-end utility, processing transactions with less direct consumer interaction, or successfully capture significant value from these new integrations? They might still process transactions, but crucial brand visibility, direct consumer relationship valuable assets could be diluted, makes them more of a commoditized service provider, less a consumer-facing brand. The regulatory environment, persistent, evolving headwind, scrutiny of card fees, expansion of regs for non-bank payment providers, not going away, likely to intensify. Could cap profitability of new services Visa tries to offer, significantly increase compliance costs across diverse global markets, even mandate changes to fundamental business practices. Regardless of tech advancements or operational efficiency, constant pressure point limits upside, creates a continuous ceiling on potential profit margins. Finally, despite robust performance, strategic investments, Visa's current valuation remains notably high, explicitly mentioned as above industry average.
The valuation elephant in the room.
Exactly. Means even with successful execution, potential for significant stock price upside might be limited for investors entering now. Much expected growth, strong future performance, arguably already priced in, reflects high market optimism, raises an important question for new investors. Is there enough margin of safety at these elevated levels? Given persistent cost pressures, macro risks, potential fundamental competitive disruptions from new paradigms. For the sophisticated investor, it's not just about hitting numbers. It's how sustainably they're achieved, at what cost relative to current stock price. High valuation magnifies these considerations. Any unexpected misstep, unforeseen headwind could have disproportionately negative impact on returns.
That's a comprehensive and important counterpoint, highlighting the complexities. Now let's pivot. Look ahead to what the market's anticipating for Visa. Very near future. The road ahead. Specifically, their Q3 2025 outlook, the strong analyst confidence surrounding it, markets expecting another robust quarter. Earnings expected July 29, 2025, further reinforces the positive trend of consistent performance we've discussed, suggests underlying business momentum remains strong. The Q3 2025 forecast highlights, incredibly promising, show anticipated strength across key revenue streams. Analysts project EPS of $2.86, represents a significant 18.2% increase year over year. That kind of ETS growth for a company of this size indicates strong profitability, efficient management. Total revenue expectation, $9.87 billion, solid 10.8% increase year over year. Top-line growth signals continued strong demand. Diving into the detailed revenue breakdown, anticipated growth across all segments. Service revenue, largely fees from banks based on payment volumes, expected $4.29 billion, 8.2% increase. Data processing revenue from sheer transaction numbers, processed projected $5.05 billion, stronger 12.5% increase. Indicates robust volume, continued reliance on Visa's core infrastructure. What's particularly compelling? Other revenue segment. Includes those high-growth value-added services. Category expected notable jump, $955.7 million. Very impressive 22.5% increase year over year.
Shows that diversification is paying off.
Exactly. Demonstrates success diversifying beyond just transactional fees, capturing more value from consulting, fraud prevention, data analytics, and crucially, international transaction revenue, higher margin cross-border payments forecast $3.60 billion, up 12.8%. Shows sustained strength in global travel, cross-border commerce. Remains a key growth engine. Key business metric forecasts also paint a very healthy picture. Continued expansion of network transaction activity. Total processed transactions expected climb to 64.47 billion, up from 59.32 billion prior year, highlighting ever-increasing volume through Visa's pipes. Total transaction value, aggregate dollar value, projected astounding $4.9582 trillion, up significantly from $3.9490 trillion. Reflects increased counts and larger average transaction sizes. Total payment volume, broader measure, purchases, cash advances forecast $3.58374 trillion, up from $3.3250 trillion. Even more granularly. CEMEA, Central Europe, Middle East, Africa, payment volume expected $219.74 billion. Impressive rise from $189.0 billion, showcasing penetration, growth in emerging markets. These numbers collectively show continued, broad-based growth across their entire network. Volume and value. Analyst consensus, management confidence further bolster this optimistic outlook. Analyst EPS estimates actually upgraded 0.1% over last 30 days. Positive sign. Favorable reevaluation as new data comes in. Visa currently holds Zacks rank #2 by positive earnings ESP plus 0.39%. For listeners, Zacks rank is a proprietary rating system, helps identify stocks with best upside. #1strong buy, #2buy. Earnings ESP expected surprise prediction indicates probability of beating analyst estimates based on recent revisions. Positive ESP suggests high probability of beating estimates.
And their track record supports that.
It does. Fantastic track record. Eaton Analyst estimates 4 consecutive quarters, average surprise 3%, speaks volumes about consistent operational execution, ability to exceed market expectations, build strong credibility. Management themselves maintains robust fiscal year 2025 guidance, projecting $39.63 billion net revenue, robust 10.3% YoY growth, and $11.37 EPS, 13.1% YoY growth. This continued confidence from the top, even with macro uncertainties, shows strong belief in strategic initiatives, solid market positioning, reinforcing positive drivers. Continued global digital payment adoption directly translates to higher transaction processing fees as commerce moves online. Sustained cross-border growth, key factor, driven by global travel, trade. Visa's asset-light model continues providing high capital efficiency, low risk, generating significant free cash flow, and of course that new $30 billion share repurchase program underscores commitment to returning substantial value, indicates belief their stock is a good investment. This looks like a company firing on all cylinders. Strong fundamentals, clear path for continued growth. Market and management clearly aligned on this positive outlook. Very compelling picture.
Okay, while the headline forecasts for Q3 certainly look promising, and analyst confidence is noted, a deeper dive into the underlying financials reveals those persistent challenges sophisticated investors must consider. Crucial to remember the projected increase in adjusted total operating costs, expected to rise by over 10%. Not a small adjustment for a company this size, driven by fundamental expenses. Higher labor costs, increased marketing spend to maintain share, rising professional services fees, higher network processing costs as volumes surge. Raises an important question for investors. How much anticipated revenue growth will ultimately be offset by these increasing expenditures? Classic margin squeeze scenario. Higher top line doesn't necessarily mean proportionally higher bottom line if costs climb significantly. Additionally, those customer incentives. Direct revenue reducer, projected to exceed $4 billion. Substantial portion of gross revenue effectively paid back to partners' banks to incentivize issuance, drive volume.
A cost of doing business at that scale.
It is, but a very large one. While necessary for growth, market share. The fact they're so substantial directly impacts net revenue Visa keeps. Makes true profitability picture more complex. Suggests achieving impressive growth might come at a higher cost than perceived. Requires continual heavy investment just to maintain leadership. Macroeconomic headwinds remain a significant concern. Despite positive Q3 outlook, guidance itself still explicitly acknowledges potential impact of economic uncertainty, tariffs, external factors largely beyond control, could quickly derail strong internal projections. Connecting to the bigger picture, significant global slowdown, trade dispute escalation, unforeseen geopolitics, could severely impact consumer, business spending, irrespective of Visa's internal strengths. Directly hits payment volumes, cross-border, revenue streams. Even flawless execution internally could be undermined by deteriorating global environment. Risks always lurking. And finally, back to the valuation elephant. Despite positive forecasts, robust performance, valuation remains high, above industry average.
Means even if they meet or slightly exceed forecasts, potential for significant stock price upside might be limited for investors entering now. Much expected growth, strong performance arguably already priced in. Reflects high optimism. Raises that important question again. Enough margin of safety at these levels, given cost pressures, macro risks, potential fundamental competitive disruptions from new paradigms. For the sophisticated investor, not just about hitting numbers. How sustainably are they achieved? At what cost relative to current price? High valuation magnifies these considerations. Any unexpected misstep, unforeseen headwind could have disproportionately negative impact on returns. Hashtag outro.
Wow. What an incredible deep dive into Visa. We've truly unpacked their robust financial performance, their commanding, maybe somewhat unassailable position in the traditional payment industry, and their relentless pursuit of innovation. Through AI, expansion into real-time payments, strategic engagement with digital assets, it's truly fascinating to see how a company of this immense scale is not just adapting, but actively leading the charge in such a dynamic, rapidly evolving sector. Their ability to consistently deliver strong numbers while simultaneously investing heavily in the future is genuinely remarkable, a testament to their enduring strength.
Indeed. And when we connect this to the bigger picture, the rapid evolution of the payment landscape, from CBDC rise to pervasive embedded finance, poses some truly fundamental questions about the long-term role, resilience of traditional networks like Visa's. While Visa's current dominance is clear, the provocative thought I'd leave you with as you reflect is this. In an increasingly fragmented, decentralized financial world, where new, often more direct ways of moving money constantly emerge, gain traction, will Visa's vast, centralized network continue to be its unassailable fortress? Or could its very scale, its reliance on existing paradigms, become a potential liability when agility, niche, direct-to-consumer solutions might gain a greater foothold? It's something for you to mull over as the global financial system continues its unprecedented transformation.
That's a powerful thought to end on. Reminds us to always look at every angle, consider broader implications of these industry-wide shifts long term. Thank you for joining us on this deep dive. We hope you feel incredibly well informed, ready to explore these ideas further on your own, armed with a more comprehensive understanding of Visa and the payments landscape. For more deep dives into the market, remember to check out Market Insight Cast on YouTube.
Please remember that this deep dive is for informational purposes only and should not be considered investment advice. Any investment decisions or actions taken based on this information are solely your responsibility. It is crucial to conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Additionally, please be aware that the information discussed in this deep dive may be generated with the assistance of artificial intelligence. While we strive for accuracy and comprehensive coverage, there may be differences or nuances in the information presented compared to original source materials due to the nature of AI processing and the distillation of complex data. Always refer to primary sources for complete and definitive information.